Okay, here I am again with the continuation of the first chart, and basically it's just kind of the redundant technique, and I'm just showing you over and over again. I do the same thing, and with a few subtle differences, but it works the same way. As we can see, here's where the other chart left off at this point. I think it was around 7:32. It starts getting narrower here as far as the Bollinger Bands. The Bollinger Bands, by the way, they contain the range of the market, whereas the blue 8 EMA line contains the trend of the market. So if it's an uptrend, the blue 8 EMA line will be acting as support until it crosses over into a downtrend, and then it acts as a resistance line. Resistance is always on top, support's on the bottom, in the way we use that term in trading. And as you can see, I've just drawn these lines where the Bollinger Band's narrowing like a woman's waist. And you basically want to trade at the hip as it starts to expand outward, but try to stay away from trading at the waist. Right here we have enough volatility, enough points between the center line and the outer Bollinger Bands, but you really want to stay away from trading at these narrow sections when it gets into like 1 or 2 points on either side. But this is enough points right here where I can probably get away with scalping a few, maybe 5 or so points. The distance from the center line to the outer Bollinger Band gives you some idea of where you'd want to probably take your profit, because that's probably all it's going to do. As you notice, it tends to trade to one side of the Bollinger Band, especially in a sideways market, and then bounce off that side and then move to the other side. So where these outer envelopes are, it gives you a good sense of where how far it's going to go, which makes the Bollinger Band just one of the best tools I've ever used, in addition to these other tools, which are all incredible. The stochastic chart on the bottom I don't really talk about much because it's not as useful, and I think it just confuses people starting out. So you can get by with these basic tools that I'm just showing you up here, and that's really all you need for just about everything you can do in the market. So let's say you do want to trade this area, even though it's getting narrower. You just know it's you're cutting off your there's a good probability you're going to get a reversal and not have much distance before it hits the Bollinger Band. Just realize that. So here we get a fake out kind of move that really doesn't cross over. If you're trading this in real time, it looks exactly like it just crossed over, so that's where it fools you. But that really doesn't matter, because if you went long, you still were heading the right direction, and then you simply get out at the top of the Bollinger Band here, same method as before, and then as it crossed back down, as you can see, the price bars themselves are in a sine wave cycle of their own. They're the finer period cycle, so they're moving much quicker. The 8 exponential moving average is moving at a little bit slower cycle, and then the slowest of all is the 14 simple moving average. So those different cycles are playing against each other, and based on the natural rhythms of the market that are present in nature for some reason, we all tend to have patterns and rhythms, and this is just noticing different, taking advantage of different rhythms in the way systems move, and it's like the ripples of of a pond when a rock's thrown in the pond and they converge at a certain point. That's essentially what you're trading, the interference pattern at the interference nodes, and they just happen to be great entry points in the market. I guess there's some universal physical laws that apply to markets and nature and everything, and for some reason this works out. It's a beautiful system. So here again, you could see where it's not as pronounced, but you can see where the blue 8 EMA line is fanning out from the magenta 14 simple moving average line, like the same like an alligator's mouth opening. And so you'd go short here, just like before. Get out as it hit the Bollinger Band. You could be fooled into entering the trade here, thinking it was crossed over, and still not get hurt. Just beware that these reversals happen fairly quickly, so you just might have to be ready on that exit at the market button. And even then, I'm usually, if I can spot these reversals, they don't quite hit the Bollinger Band. If I'm very quick on the market, I'll still get a few points. It might reverse on me and head down, and I get out, but I've still got a couple points, which isn't bad. And I'm trading in an area where I probably know that I shouldn't be trading anyway until it starts expanding again, as you see here. Now we know the volatility is increasing as the Bollinger Bands expand away from each other, and so these are not directional really. They just tell you that the market is moving somewhere. It's starting to trend a little bit. So we get in at the next crossover, which is right here. Get out at the Bollinger Band up here. Voila, we're making some serious chunks of money here. And we see it's crossing back over here. Same exact thing. Nothing too difficult to remember. Get out at the bottom. We see there's two types of trading. You're trading the crossover points, and you're trading the trend continuation trades. And you can tell these are usually good when see how that curve, when it starts angling in, you got to be cautious because it might be trying to cross over. So you want to wait for that curve to come back down in the direction you're trading. Just have a little patience. Even if you got in early, we're impatient. You're still, if you've got a target set, let's say you've got a 3 or 4 point target set, you'll get out, get your profit right there, and then get right back in the trade here. And a good rule of thumb is when I'm trading against, I'll show you how to trade the intermediate level. Right here, this is the minor level swings. But we're always trading in accordance to where it's going on the intermediate level, and I've got a different chart open so I see that at a glance. But when you're trading in terms of the direction, the trend on the intermediate chart, that's a good time to use what I call a trailing stop strategy, and that means just let the market ride and give you all its potential. When you're trading against trend or counter trend to the what it's doing on the intermediate chart, the 5-minute chart. This is the 1-minute chart, so the 5-minute chart stands for my intermediate swings. So when you're trading the counter trend swings, I'll use targeted trades for those. In other words, I might have the automatic target set to be hit, and I can show you how to set those. So there's two types of trading methods: the target method, which I use for counter trend trades that are counter trend to the intermediate level swings, and I use the trailing stop strategy when it's moving in the same direction as the intermediate trend. If that makes any sense, it'll make much more sense if I show it. And so basically, I'm sticking in this trade until it hits the Bollinger Band, or it gets me out at a trailing stop loss. Either way, I'm going to be making profit in the direction of the trend. It's a question of how much. And so here's a continuation here. Could have been faked into entering it. A short trade there wouldn't have been hurt at all. But here's when it really takes off. That's the one you want to try to practice getting the moment it starts moving in your trend direction. We get out at the as it crosses the Bollinger Band here, and repeat. It's wash, rinse, and repeat is basically the name of the game. No matter what the market's doing, the beauty of it is you're using the same method, so you don't have to really be that inventive all the time. You're just applying you have to be like a little bit like a machine, and you just get the signal and you make your trade. At this crossover, you can see it didn't hit our Bollinger Band, but we were kind of warned off from taking this trade because look what that Bollinger Band is doing. It's narrowing. That's saying, hey, wait a minute, the volatility's decreasing to a level where we're probably not going to hit our targets. And so the time you want to get in is a few moments later. It's expanding outward again. You want to trade at the hip, avoid that waist area. And so we get our alligator mouth opening here in the trend direction, and there's a good entry point. Get out at the top of the Bollinger Band envelope. You can keep doing that all day long. Just get out here. Now it gets a little bit like popcorn up here. I call these little when it starts rounding over like this, I get a little bit worry, I guess the right word, that trend change might be coming. So I want to start seeing when it starts doing this and starts narrowing, I get a little bit cautious about going in the same trend direction. So I might not take these trades. I might start looking for trend change patterns, and then when I finally think it's crossing over, I can get a little bit of a profit out of it there. But again, I might not even take that trade because we have a narrowing band, and now we're in a little narrow sideways channel. I might avoid that channel altogether. I don't need to take every trade because look at how profitable we've been up to this point. We just don't need to take everything unless we think it looks good. So that's the continuation of the chart, and you can see that the same rules apply. Nothing really violates these rules. That you can apply them to every market, and it doesn't matter how the characteristic of the market is behaving. The rules will still work. It's just you have to scale it down appropriately to the scale of the market you're trading. All right, this marks my second video, and I'll keep putting these up if you want them. Have a good one. Now I got to turn this thing off. I haven't edited these things yet, so I don't know what I'm doing, but what the hell.